For decades, you've been fed the same fairy tale by your parents, your bank, and every real estate agent in a cheap suit. Buying a home is the best investment you'll ever make. It's the cornerstone of the American dream and the global dream. The narrative is seductive because it's wrapped in deep-seated emotional security. We are told that renting is throwing money away or paying someone else's mortgage, while buying is building equity and investing in your future. On the surface, it feels incredibly logical. You look at a house and see a tangible asset. You can touch the walls, plant a garden, and watch your kids grow up in the backyard. Unlike a volatile stock that can vanish in a market crash, your house stands still. There's a primal comfort in knowing that as long as you pay the bank, no landlord can ever kick you out. Furthermore, the forced savings argument is a powerful psychological anchor. Most people are terrible at saving money. Therefore, the logic goes, if you are forced to make a mortgage payment every month, you are at least building a nest egg in the form of home equity. We've all heard the stories from our grandparents about how they bought a house for $30,000 in 1970 and sold it for $500,000 in 2020. It looks like a massive win. It looks like wealth. The industry spends billions of dollars to reinforce this belief. Banks want to take out a 30-year loan because you become their most reliable source of interest income. Real estate platforms show you beautiful, filtered photos of your forever home to trigger your dopamine. You are told that a house isn't just a place to live. It's a forced savings account, a tax shield, and a retirement plan all rolled into one. It's the safe path. It's what responsible adults do. But what if I told you that the safe path is actually a financial treadmill designed to keep you running in place for 3 decades? What if the very thing you think is making you rich is actually the biggest drain on your net worth? The emotional comfort of homeownership is real. But as we are about to see, the math tells a much darker story. You aren't buying an asset. You are buying a full-time job that you pay to go to every single day. Now, let's strip away the white picket fence and look at the cold, hard math. The financial industry loves to show you the appreciation of a home's price, but they conveniently ignore the unrecoverable costs. The reality is that a house, by definition, is a liability. It takes money out of your pocket every month. An asset, by contrast, puts money into your pocket. Let's run the numbers. When you buy a house for $$/$500, $000 with a 20% down payment, you think you invested $$/$100, $000. You haven't. You've just locked it up in a non-productive pile of bricks. Over a 30-year mortgage at a 6% interest rate, you won't just pay $$/$500, $000. By the time you cut that final check to the bank, you have paid nearly $$/$860, $000 in total. That's $$/$360, $000 in interest alone. Money that vanished into the bank's profit margin, never to be seen again. But the interest is just the beginning of the bleeding. Let's talk about the 3 horsemen of real estate costs: taxes, insurance, and maintenance. Property taxes. In many regions, you pay 1% to 2% of the home's value every year. Over 30 years, you've paid the government the entire value of your house all over again. Maintenance. The 1% rule states you should spend 1% of the home's value annually on repairs. Roofs leak, HVAC systems die, and pipes burst. These aren't investments. They are expenses required just to keep the value from dropping. Inflation. That $$/$30, $000 house your grandfather bought in 1970? When adjusted for inflation, $$/$30, $000 in 1970 is worth roughly $$/$240, $000 today. If he sold it for $$/$500, $000, his massive gain is actually much smaller than it looks once you subtract 50 years of taxes, insurance, interest, and renovations. Robert Shiller, a Nobel Prize-winning economist who studied 100 years of housing data, found that from 1890 to 1990, the real return on residential real estate was virtually 0% after inflation. Compare that to the S&P 500, which has averaged roughly 7 to 10% annually. The math doesn't lie. When you factor in the purchase costs, selling commissions, usually 5 to 6%, and the endless stream of unrecoverable costs, most homeowners are barely breaking even. You aren't building equity. You are paying a premium for the privilege of saying you own the dirt you sleep on. You are essentially running a small business where the overhead is 90% of your revenue. Does that sound like a great investment to you? The true danger of the homeownership myth isn't just the money you spend. It's the opportunity cost of the money you can't spend elsewhere. When you lock $$100,000 into a down payment, that capital is officially dead. It's not compounding in the stock market. It's not fueling a startup. It's sitting in your floorboards, doing absolutely nothing for your net worth while inflation nibbles away at its purchasing power. Think about liquidity risk. If the stock market drops and you need cash, you can click a button and have your money in 2 days. If the housing market drops and you need cash, you are stuck. You have to list a house, pay a realtor 6%, wait months for a buyer, and pray the appraisal comes in high enough. Many people find themselves house rich but cash poor, living in $1 million asset, but struggling to pay for a broken radiator. You are essentially a prisoner to your own equity. Then there is a mobility tax. We live in a global, fast-paced economy where the ability to move is your greatest career leverage. If a dream job opens up in another city with a 40% salary increase, a renter can leave in 30 days. A homeowner is anchored. You are tied to a specific geographic location, forced to turn down opportunities because you can't sell your house fast enough or because you're underwater on your mortgage. This lack of mobility can cost you millions in lifetime earnings that no appreciation will ever cover. Beyond the finances, consider the psychological toll. Homeownership is marketed as peace of mind, but for many, it's a source of constant low-level stress. You aren't just a resident. You are a property manager, a landscaper, and a security guard. Every time it rains too hard, you wonder if the basement is flooding. Every time the furnace makes a noise, you see dollar signs flying out of your bank account. By following the mainstream advice to buy as much house as you can afford, you are effectively committing financial suicide by installments. You are sacrificing your most productive years, your 20s, 30s, and 40s, to service a debt for an asset that provides no cash flow. You are trading your freedom for a sense of permanence that is largely an illusion. You aren't building a kingdom. You are building a cage, and you're paying the bank for the privilege of holding the key. If you want to build actual wealth, you must stop thinking like a consumer and start thinking like an investor. The new way is about never owning property. It's about decoupling your shelter from your investments. You need to stop viewing your primary residence as a profit center and start treating it as what it truly is, a lifestyle expense. First, embrace the rent and invest the difference strategy. If renting a similar home costs $$2, $500, while a mortgage, taxes, and maintenance would cost you $$4, you aren't throwing away $$2, $500. You are saving $$1, $500 every single month. If you take that $$1, $500 plus your original down payment and put it into a low-cost S&P 500 index fund, history shows you will likely end up with millions more in liquid net worth than the person who bought the house next door. You get the lifestyle you want without the anchor of unrecoverable costs. Second, if you must buy, follow the rule of 5%. Calculate the annual unrecoverable cost of owning, roughly 5% of the home's value, including property tax, maintenance, and the cost of capital, is lower than the annual cost of renting. If renting is cheaper, rent. Don't let ego drive your financial decisions. Buy a house only when the math makes sense, or when you are at a stage in life where you are willing to pay a luxury tax for the stability of owning, knowing full well it's an expense, not an investment. Third, consider house hacking or commercial real estate. If you want real estate to make you rich, it must produce cash flow. Buy a duplex, live in one unit, and rent out the other. Now, someone else is paying your liability for you. This turns your home into a legitimate asset because it finally puts money into your pocket. Finally, prioritize liquidity and mobility. Keep your capital in assets that pay you to own them, stocks, bonds, or cash-flowing businesses. In the modern economy, your ability to pivot, move, and deploy capital instantly is your greatest competitive advantage. Don't trap your life's work in a pile of wood and shingles just because that's what everyone else is doing. The math doesn't lie. Those who own their time and their capital win. Those who are owned by their mortgage stay in the middle class. Stop buying liabilities and calling them assets. Start building a portfolio that actually sets you free.